Hey everybody, welcome back to Matt Money and welcome back to take 3 of this particular video. Today we're going to be talking about the number 8 position in the dividend portfolio here. So we have about $315,000 invested into an assortment of different stocks. I'm highlighting over the next couple of weeks the top 10 of those. We've already went through number 10, we've already went through number 9, and today we're going to be talking about number 8. And this is just basically part of a $461,000 portfolio, of which I'm getting about $15,000 worth. And keep in mind that all that $460,000 isn't in a dividend income aspect of the portfolio. Some of it is in a 401k. So that of the $315,000 that I can invest in individual securities, I'm getting about that $15,000 coming into the portfolio. That equals just under 5% on terms of yield and yield on cost, because actually where we're at right now, we are slightly down on some of the positions because I invest monthly, right? I'm not a swing trader. I don't do that. That's personally not my style. So I buy and hold for the long term and for the dividends. Looking at the capital allocation by sector, what I'm going to do now is kind of highlight what sector we're going to be looking at, and then eventually we'll start to unravel what stock we have at number 8. So as usual, you guys are probably used to this by now. For capital allocation by sector, we have energy, financials, and real estate leading the top 3. Actually, number 4 is industrials, which is actually where we're actually going to be looking at our number 8 stock for today. And what you will actually notice is that it's currently at about 9.3% of the $315,000 portfolio, so it's just under $30,000. And if you scroll over to the income by sector, you can see that industrials kind of takes a huge hit, right? Comparing it to, say, consumer staples, energy, financials, real estate, and healthcare, it's smaller than that at about 4.7%. So instead of being the top 4 in terms of the sectors, it's definitely going down into the bottom half of the sectors in terms of income. Why is that? Well, I do have some industrial stocks that don't pay any dividends at the moment. They're hopefully kind of spec plays, and also some of them are just badly beaten and have suspended dividends, and we'll be talking a little bit about that a little bit later. But that being said, this as overall has about a yield about 2.4%, which is relatively low. But the stock we're going to be looking at today is going to be much significantly higher than that. And it definitely plays almost half of what we're looking at in terms of the industrial income coming from this portfolio. So without further ado, let's just take a hop over to the top 10. So if you guys are familiar with it, top 10 was Bryn Mawr Bank. Number 9 in the top 10 was Bank of Nova Scotia. And number 8, which is what we were talking about today, is Caterpillar in the industrial sector. So I have, let's just take a quick look, 75 shares of Caterpillar at this moment. I think I started buying back in the September-October timeframe of 2019. So going on 9 months with this position overall, and I've continued to add to it every time I think it drops down. I've bought shares starting at 119. I bought my first 38 shares of it. I bought 14 shares at $106. I bought $1,500 worth. I'm not exactly sure how much or how many shares that was. If that was, say, 15 shares at $100 or what have you. I bought 7 shares at $108 basically, and so that has gotten me to a cost basis of around $110 a share, with the current share price at about 126 bucks. So that gets me about 15% up in terms of gains, over $1,200 in terms of gains on a dollar amount. But like I mentioned to you guys, generally I don't go after the gains in terms of dollar amount. I'm going after that cash flow, right? So I'm going after that $15,000 a year. Hopefully next year it'll be $21,000 a year. And that's hopefully what I'm going to be using that money to either pay bills in the future or use that to fund other businesses right now. So of that $15,000, $312 is coming from Caterpillar, and that comes from a pretty decent payout ratio of about 3.2, 3.7% if you're looking at the yield on cost, or about $4.12 a share. Real important news is that it really pays dividends in the second month of every quarter. So if you guys are looking for a second month payer, this is potentially one that you can look at. You basically go ex-dividend in the first month of every quarter, and then it pays out about a month afterward. We're looking at right now $1.03 per quarter, and basically with the 70 some shares that we have, looking at just over $78 every single time. Now, what I eventually want to get this portfolio up to in overall payments is about $400 a year in dividends, or just under or just over rather 100 shares, so I can actually start utilizing this to write some covered calls in the future. Currently, the market value of all these shares is sitting at about $9,600. It's actually surpassed the number 7 position, but since we're basing this off of the June 20th, 2020 sort of vision here, we can't really change the lineup. I could, but I'm just not going to. So you can see that a lot of these stocks here are kind of aligned relatively closely. Number 5, there's actually 2 positions here in 2 different accounts, but it's the same stock. So wanted to group those together. But you can see we're heavily crunching up against this $10,000 mark for a lot of these positions. And so I think that that currently is something you can kind of take away at. For my $315,000 portfolio, I'm generally speaking trying to get stocks to that $10,000 to $15,000 range at this point. So that leaves me, if I were to say have everything in that sort of amount, about 30 stocks that I could potentially, fingers crossed, hold, but I know I hold way more than 30 positions at the moment. Just some other quick stuff maybe to kind of look at here. Market cap about 68 billion or so. Earnings per share is about $9.44. PE is about 3.4 times earnings. Price open, price close, rather volatile. $3 spread every day so far today. Let's just see. 52-week low is about $87, and we are 44% up from there, and we're about 16% down from all-time highs, which was about $150 per share. Beta, it's a little bit more volatile than the S&P 500. It's got 541 million shares outstanding, and I own 0.00014% of the company. Now, just hopping over to, say, Yahoo Finance to get a little bit more information and look at things maybe in a little bit better manner. You can see we go ex-dividend date in about 3 weeks now. 1 year price estimate is about what the price is at the moment, so it's about $126 at the moment. Price to earnings hasn't changed for the past 12 months here compared to what we were just looking at on my Google Sheets, about 13 times earnings. Earnings per share is about $9.46, and we'll hop into that a little bit more in a moment. Market cap is about $69 billion, which, if you were to look at the balance sheet, is a pretty scary number, but we'll get into a little bit more about how this thing can generate some pretty good cash in just a moment. So, like we mentioned earlier, 52-week range here is about $87 to $150. And yeah, I think that it's a pretty good stock, and I'll probably go into a little bit as to why. But let's first hop into a comparison between this stock and the S&P 500. So the darker blue is Caterpillar over the past 35 years, and the lighter blue is actually the S&P 500 over the past 35 years. So you can see they've crossed over very early on. So the S&P 500 was actually outperforming during the 90s. Then after the 2000 bubble, things kind of came crashing down. They kind of came back to normal, and then Caterpillar kind of took over. But Caterpillar did have some pretty big declines here in the 2008 crisis, and then it kind of did bounce back up to take back the reins from the S&P 500. But you can see that, generally speaking, in times of trouble, Caterpillar takes a little bit of a bigger hit than you would expect. So in any time of recessionary period, it might be an opportunity for you to pick up Caterpillar if construction is slowing or anything like that. You can see we peaked at over 900% returns over the past 35 years, but currently residing at about just under 700% compared to the 500% of Caterpillar. Now, maybe you don't care about the last 35 years, but let's go into a 5-year view. You can see Caterpillar and the S&P 500 are basically neck and neck with each other. So Caterpillar briskly defeats the S&P 500 by basically 2 percentage points, 3 percentage points there. But you can see here that it's relatively because Caterpillar has been flat or declining over the past 2 years or so. The past 2 years, you can see obviously Caterpillar has taken a hit, whereas the S&P 500 has gone up 12%. And let's just take a quick look at the past year. I would assume it's very similar as well, whereas the S&P 500 is up about 3-4%, with its best being close to 15% up over the past year, whereas Caterpillar is down 7%, with almost being up about 10% before it started going into these March lows here. So that's a pretty good comparison between the S&P 500. It is a Dow component, I believe, so this is something that you could potentially consider diversifying if you were to, say, invest in a Dow component rather than specifically Caterpillar. And let's just take a quick look at the year to date as well. Caterpillar is down 14% since the beginning of the year, and we're down 5.5% on the S&P 500. So about 9% discrepancy between the two. You can see the S&P 500 returned a lot quicker, with Caterpillar kind of being a little bit more sluggish. But you can see very early on, Caterpillar was taking a hit way faster than the S&P 500, and I think that has a lot to do with the tech stocks that were kind of propping up the S&P 500 in the February timeframe. Now, let's just do a quick look at the balance sheet, then we'll go to the income statement, and then go to the cash flow statement. So what I want to look at specifically here is the stockholder equity that we have. So here we have the assets on hand, current assets, cash, net receivables, inventory, as well as some goodwill. So goodwill is about $6 billion worth of brand name, which is pretty significant. It's about 10% of the company's value. Is this, hey, Caterpillar's got this great brand name, and people know Caterpillar, and so this is like the licensing fees or anything that they can basically charge to bring in income based off of their name and their basically their brand that they've established over the past couple decades. And then they have liabilities, right? So of which what are really close-up liabilities and which was are more long-term liabilities. You can see they have about $11 billion worth of debt kind of in the near term, but in terms of long-term debt, about $26 billion in long-term debt. Stockholder equity, if you were to break that down, assets minus the liabilities, we have about $14.5 billion in terms of stockholder equity, compared to the $67 billion in the market cap. You can see the price to book value on this company is hugely out of whack. But that being said, the company does make a decent amount of income, and so the company is obviously being valued based off of the income, not necessarily by the book value of the company. So what I mean by that is when we look at the income statement, which we have switched to now, we can see for fiscal year 2019, just looking at it, the top line growth of the company was up to about $53.8 billion. Cost of revenue was about 37. So they walked away with about $16 billion in gross profit, of which they had operating expenditures of about $8 billion. So that let them walk away with about $8 billion in terms of operating income. And then with everything said and done, like having to pay income taxes and other expenses and interest expenses, they walked away with about $6 billion in net income. Now, think about it this way. It's a $67 billion company making $6 billion in net income. That sounds like a pretty good deal. Now, if you start thinking about what everything was before taxes, depreciation, and amortization, they had about $10 billion in EBITDA, which is pretty good, almost $11 billion. And in 2018, they actually did make $11 billion in EBITDA. So things were looking pretty good from a before tax and depreciation and amortization standpoint. So you think about it that way. If you were to look at the net income, not on the trailing 12 months, but just on the current 2019 income, we're looking pretty good, about 11 times, maybe 12 times earning if you're kind of being a little bit more conservative on the upper hand there. But with the trailing 12 months, just looking at the quarterly results here, you can see that in the March time frame, they did lose a little bit of revenue. So the quarters before, they were looking at about $12 to $13 billion in revenue. The cost of this revenue came down also. So just because they weren't selling as much, they also didn't have as much in terms of costs associated with everything. Gross profit was about 3.2 billion compared to 3.8 and 4 billion the previous quarter and 6 months ago quarter comparably. Operating expenditures about 1.7 billion again. Let's just see, and net income after everything was all said and done was about 1 billion. So things were looking pretty good compared to last quarter. But then again, the quarter before that, and basically 3Q of 2019, they had about 1.5 billion in terms of net income. So uh, that all being kind of taken into account, we've had two bad quarters. Not necessarily sure if that has a lot to do with things going on in the latter half of the year last year in, say, China or something like that. But overall, things are holding up pretty good, I would say. They're still able to make a little bit of money, and I think what they did is they just took some tax charges to just make sure that nothing was going to impact them um, in the long term. So let's just take a quick look at earnings per share. And if you look at earnings per share over here, you can kind of see that their earnings have kind of been declining, and I think that has a little bit to do with the entrance to a recession that we kind of have experienced right now. And we walked away with about $1.60 in terms of earnings, and Q2 we're expecting about 57 cents. So things will come down. Hopefully they will beat earnings in Q2, which is supposed to be in about a month or so, but who knows what is going to happen. But overall, if you kind of go back to annual, let's just kind of take a quick look at the growth of the company. You're going to see that the amount of income that has been generated is pretty substantial, right? So if you were to look specifically at the growth of the revenue, we went from about 38 billion up to 53.8 billion, which is a pretty substantial increase. For net income, we went to basically negative 670 or 67 million, which I think was a fluke, all the way up to 6 billion here. And I think a lot of that has to do with one-off tax items that we were observing in this 2016 time period. And now that things are looking a little bit better, yeah, and I think the same thing happened in 2017. There was one-off tax items here that basically had to be written off. So that way we ended up walking away with a little bit less in terms of net income compared to what we would have expected. Now, where the actual cash comes in with kind of removing some of those one-off tax items, the cash flow statement. It's my favorite part of looking at a business. Let's just look at 2019, for example, 6.9 billion in terms of cash flows coming from operations. You have about 6.1 billion coming from the net income. Add the 2.5 billion in terms of depreciation. You do have a working capital loss here, but accounts payable. But you also have a working capital build and some non-cash items that also helped with $675 million coming in. Overall, you're walking away with about 6.9 billion in terms of cash flow coming to the organization. Now, what do they actually spend in paying dividends? So they back in 2016 were paying about 1.8 billion in dividends a year, 1.8 billion dollars in dividends a year coming back in 2017. Now going back to 2019, they're paying about 2.13 billion dollars in dividends a year. But looking specifically at how much they're using to invest into the company, they're only spending about $2 to $3 billion in capital expenditures a year. So if you're averaging about $6 billion or $5.5 to $6 billion, even $7 billion in terms of cash flow, that means you're walking away with, $2.5 to $4 billion worth of free cash that you can use to pay the dividend, and any sort of remainder you can use to, say, buy back stock or something of the like. So like we had mentioned, when you have this free or this net cash provided by the operations here, you're getting about 6.9 billion. You walk away with a decent amount of investment back into the business, the 1.9 billion here. So you're walking away with just under $5 billion in free cash that you can use. And of course, that has a pretty good payout ratio for the dividends that you're paying, right? So you're walking away with $4 billion you can use to pay the dividend, and you're only paying about half of that, right? So same with last year in 2018 timeframe, 3.6 billion in terms of free cash, you're only paying about 1.9, almost 2 billion in terms of dividends. And the year before, 2017, you're walking away about 3.4 billion in free cash, and you're paying about 1.8. And then the same the year before. Although payout ratio is looking a little bit worse back in this 2016 time frame here, but you can see that they're still holding about $8 billion of cash. They're trying to maintain this sort of build here, and I think what they're doing is they're just reissuing debt to be able to lower their basically debt obligation in terms of interest, but at the same time leverage themselves so they can continue to expand the business and invest and make sure that everyone is happy and manage shareholders expectations as well. So in terms of me looking at it like this, I think that it's a relatively well-run business. I think that it has a really good opportunity to continue to pay the dividend in the long term. Anyway, this is a quick look at it. I think that in the long term, I think things will kind of go back to normal, especially once we kind of go back to a growth period. I think it's a good opportunity to look for Caterpillar in the future. I think that it's going to continue to struggle as things in the pandemic continue to arise and more shutdowns happen, and less people build real estate and construction and everything like that. But with infrastructure bills potentially occurring in the United States and a bunch of places continuing to build across the world, I don't think Caterpillar is going away. It's one of the key heavy equipment providers across the world and has a great brand name, and I think it'll continue to be something that is utilized in the future. So yes, if you're able to accumulate shares now when the price is down and it continues to kind of struggle, you might be able to eventually reap the benefits in, say, 5 to 10 years from now when we start reaching an expansion in the economy again. So that's just my thought. Not sure what you guys are thinking. I think that it's a good one for the long term. I know Uncle Bill from Microsoft owns this bad boy, so could be something that you can put into your portfolio and reap a pretty good benefit of dividends in the future, because it is a pretty good dividend pair and it has been continuing to grow the dividend for quite some time. Anyway, guys, I'm going to edit this video. This is the number 8 position in the top 10 as of June 20, 2020. And so I'm just going to make myself some dinner and I'm going to call it a night, and I'll talk to you guys on the next video. Cheers.